Good morning and happy Friday from our global headquarters in New York. I'm Danny Berger. Manish is out again this morning on assignment. Welcome to Bloomberg Brief. Let's set your agenda. Kicking the can, the yen slumps as the BOJ makes investors wait another month for details on paring its bond buying. A win for Elon Musk. Tesla investors vote their CEO's $56 billion pay package and the firm's move to Texas into a deal. And meme stock investor Keith Gill makes GameStop moves, appearing to chuck out all of his options while loading up on shares. Well, it is a record every single day of the close for U.S. stocks. Fourth consecutive record highs for U.S. equities is today another one. We do pair some of those gains this morning down 0.2%. It has been narrow gains. It has been led by tech. But it is clear this morning that we did see some clear pairing of the bets, rather adding to bets for cuts. We're down by nearly 2 basis points yet again this morning. 422 is where you stand on your 10-year yield. We are down nearly 19 basis points for the entirety of the week. It was PPI and higher jobless claims that led to adding fuel to that. Would the Fed have made a different decision if they had had that data in hand? European equities, the divergence is in. You see the CAC 40 at the bottom of your screen, down 1.5%. European equities down 1/3%, while the U.S. makes all-time highs. This is not American exceptionalism. This is European exasperation. That is the trade that is in play. And then the yen. Let's take a look at that. It is trading at its weakest level since May. A BOJ decision. Governor Ueda just moments ago wrapping up his presser. Ueda kicked the can and will only specify the BOJ's plan to wind down the bond buying at the next meeting. Joining me to break down the details is Noor Al-Ali from Bloomberg's Market Lives team. So, Noor, what did we hear?
Good morning, Danny. Well, look, that yen is continuing to weaken, and there are a lot of risks now of intervention because there's still not enough clarity for traders to see on what what the scope or that pace of bond buying is going to be from the Bank of Japan. Now, Ueda was asked, is there a scenario where they would also raise rates and cut down their purchases? And he said, well, yeah, it's possible. But you saw the reaction in the yen afterwards. It's still hovering near the lows in quite some time. And reminder as well, Danny, that officials in Japan did step in to prop the currency last month in the biggest operation ever on record. And so that renewed risk of intervention comes as the yen hovers near a 3-decade low, is not looking good. And also reminder that weakening of the yen is inflating those price pressures in a way that's quite unfavorable and hard to tame, also denting consumer sentiment. So the Bank of Japan has a lot to consider for its July meeting, and that's quite interesting for traders in the run-up to that as the yen continues to slump.
Okay, Noor, thank you very much. Noor Al-Ali there from our MLive team. Yeah, the yen this morning currently trading at, let me just pull it up, 157. So we're getting closer to that 160 level that we last saw intervention. Let's get over to Mark Dowding of RBC BlueBay Asset Management. Mark, let me just get your first take of what you thought of the BOJ decision and what we heard from Ueda.
I think in many respects today was a disappointment. We had hoped that you would actually see more decisive action to reduce the bond buying. I think that bluntly, at a time where every other central bank is delivering quantitative tightening, we've still got easing a balance sheet in Japan, and that QE continues to be the driver of a weak yen. It's almost as if Ueda doesn't really care about the level of the yen, which must be something that's exasperating his other political counterparts.
Mark, if I can just jump in on that point, because we've heard different Uedas. Last BOJ meeting, he also didn't really care about it. But then last month, I pulled up some of what he said. He said, we'll closely monitor how a weak yen will affect prices. That abrupt one-sided weak yen is negative for the economy. And then, as you say, we get this press conference where not only does he not say that, he refuses to actually comment on the yen when asked a question. So which Ueda should we be listening to?
Well, I think bluntly, actions speak louder than words, don't they? And the fact is that although in the press conference today, some of his comments were maybe designed to be a little bit more hawkish sounding, the reality is that the inaction today is a relatively dovish signal. And I would infer that if it weren't for the fact that we're seeing a risk-off trade across European assets first thing this morning, and that's creating a bit of a flight to quality bid for safe havens, and that's actually something that's actually a factor that's benefiting the yen. If it weren't for that, I think that we would be north of 158 and really talking about setting up a test of 160 on dollar yen and speculating about when we might be needing to see a further round of intervention.
Do you think that played into Ueda's mind, looking at what's happening not just in Europe and a weaker euro, but also in the U.S. with inflation data coming in and perhaps the weakness to the dollar that will bring? Is Ueda just saying, hey, I can play for time here. There is no rush?
Yeah, well, so one of the things that sometimes surprised me in my dialogue with the Bank of Japan, it sometimes seems they spend more time trying to analyze the US economy and US data than they do their own domestic data. For a long time, they've been trying to predict a recession that's never come in the US. And one of the reasons, bluntly, why I think the Japanese authorities have been caught out and the yen has been as weak as it has been is because the BOJ have wanted to believe that the US would start cutting interest rates already. And I think that in some respects, they should be paying a bit more attention closer to home, because there's no doubt that the policy setup is currently more stimulative than it was at a time when deflation was a much bigger threat back in 2016. We continue to see inflation running ahead of target. And actually, this is stoking inflationary pressures. And there's a danger. The more the BOJ gets behind the curve here, the more the danger is they're going to have to overreact and tighten policy more aggressively, say at some point in 2025.
Well, just to play devil's advocate, I'm sure part of what's going into Ueda's thinking of taking his time is some of the growth figures we've seen. GDP shrank 1.8% in the first quarter. Sure, wages were higher, Mark, but it's not necessarily clear that that's translated into consumer sentiment. Why isn't that not right? Why doesn't that say that they should have patience, that they shouldn't be rushing into dwindling the bond buying program and to be raising rates?
Yeah, well, I think the just on GDP data, there were some special one-off factors, right? There was the Kansai earthquake at the start of the year that impacted GDP figures on the back of a auto shutdown. So we've had some disruptions to GDP, but underlying economic data is strong. It is robust. The trend is there. In terms of underlying sentiment in Japan, it feels as if there's almost this narrative of a lost generation rising up as Japanese citizens are becoming a little bit more confident in terms of the outlook for their country on a forward-looking basis. The reflation trade is on in Japan would be the message. We're not arguing about sort of the BOJ moving to a restrictive policy stance. It's just the fact that this overtly accommodative position that they find themselves in, where they're not just running 0% interest rates when inflation is running 2.5%, 3.5%. They're also delivering QE by continuing to grow the balance sheet. Again, this is a factor that's only contributing to yen weakness and is stoking those inflationary pressures further.
So do I take it you don't really buy it when Ueda says, as he said many times during his press conference, we don't use the reduction of JGB purchases as an active monetary tool, something he's continued to say since March, since he kind of let go of the reins in their control of government debt yields. Do you just not buy that?
Yeah, I think plainly speaking, that's a wrong thing to be saying. I mean, when you're delivering QE, this is being done to deliver policy easing. QT is delivered to conduct monetary policy tightening. I'm sure that this is very clear to Ueda. So maybe he's trying to dance around and be careful about what he's saying. And I think there's almost this sense in which they want to move on a very conservative path. But bluntly, controlling both the supply as well as the level of interest rates. These are key monetary policy tools used in conjunction, and it is overtly the monetary policy of the BOJ which is responsible for the weakness of the yen at this point, because we can all see otherwise the yen's a really cheap currency. It's a currency I'd like to own, but the BOJ are making it impossible for me to buy it.
Yeah, I know you've said this before, that you really cannot buy the yen or go long in the kind of chatter that we've heard because of the back and forth of the BOJ. I mean, Mark, this is pretty scathing criticism of Ueda. Is there anything he's doing right?
Look, the country is in a good position. I'm just fearing that actually by being too far behind the curve, you're setting up a real problem for times to come. Because if the BOJ gets too far behind the curve and they end up needing to over tighten, then that's going to be something that ends up choking off the Japanese economy in a future point in time. So yes, I feel somewhat frustrated that the BOJ, not just UAIDA, but the entirety of the BOJ doesn't really sort of see the narrative that actually they are responsible for driving yen weakness. And they should be sort of turning to actually adjust policy here. But otherwise, look, time will tell whether he's the smart guy or not. But I do think that the reflation trade is there for all to see. And I think that the BOJ at this point are behind the curve, and the FX is showing that that is overtly the case.
Well, to that point, Mark, when you last spoke to Bloomberg in April, you said that you were maxed out on JGB shorts and all the relevant funds, that you could do that. Do you still have that position?
Yeah, absolutely. I still am very convinced that policy is going to be normalizing in Japan. I mean, we've heard today that we're going to see a substantial reduction in JGB purchases after the July meeting. If you compare where the 10-year JGB is compared to the 30-year JGB, it's a very wide spread. It kind of shows you how artificially rich 10-year JGBs currently are. We think that those yields should be north of 125. And so with that being the case, with the reflation trade on, with the yen remaining weak, with inflation moving higher, you can be confident that JGB yields are only going in one direction. So we're very happy to
Mark,
sit with that
just
position.
Quickly, because we have to wrap this up soon. Do you think that they can hike in July or no, now that we don't have the bond buying details?
So given how UAIDA has been behaving, I think that that's unlikely that they'll be doing both things at the same time. September is probably the earliest now.
All right, Mark, we really appreciate your time this morning. Mark Dowding of RBC BlueBay Asset Management with some clear words for UAIDA there. Okay, let's get to some of the other top stories trending on the terminal this morning. Wells Fargo has fired over a dozen employees last month after investigating claims that they were faking work. A review found that they were simulating keyboard activity, creating an impression of active work. Another thing where you kind of toggle the mouse. Wells Fargo started requiring employees to return to the office 2 years ago under a hybrid flexible model. A judge looks set to reject a $30 billion settlement between Visa, MasterCard, and retailers, which would have had capped credit card swipe fees. The federal judge suggested that she would not sign off on that deal. Retailers have long fought against fees for processing card payments, most of which go to banks that issue the cards. And some luxury labels are discounting their products like never before to woo Chinese buyers. Balenciaga, Versace, and several other premium brands have slashed prices, some by more than half. This price war would have been unthinkable just a few years ago for the labels whose growth stems from an image of exclusivity. Okay, coming up, Tesla shareholders back Elon Musk's pay package and the proposal to move the company's legal home to Texas. And Manish Kabra, head of U.S. equity strategy at SocGen, joins us to look back on a divergent week of fortunes between the U.S. and European equity markets. We'll give you the context here on Bloomberg.
Tesla's also the leader in real-world AI. So there's really, this is a big deal. Like Tesla is ahead of Google, Meta, OpenAI, anyone on real-world software, actually taking in video and making decisions based on video. No one is even close. And it's getting better.
Bold claims about Tesla's AI leadership at the company's annual meeting yesterday. And Elon Musk gets perhaps a more relaxed Elon Musk after his leadership and his pay package was voted in by shareholders. That was the $56 billion pay package. And then at the same time, moving their company's legal headquarters to Texas. Dan Ives writing in after it that the proposal passes, an overhang is removed, now putting the price target at $350. Let's get over to Bloomberg's Craig Trudell on this. Greg, okay, so shares rally yesterday when Elon Musk tweeted out that it would pass. It passes. Tesla continues to rally. The question is when we hear Elon Musk, who's more emboldened, talking about their AI bets, talking about being a robotics company, talking about $25 trillion market cap. Is this actually something that the market is going to like and embolden Elon Musk?
I guess, there will be a contingent of people who will, respond to this with color me skeptical. And I think back to, past events when Musk, talked about within a year having, millions of robo-taxis on the road. At the time that he was making those predictions, he was offering autopilot and these driver assistance systems. That's really still where they're at, 5 years later. The sort of narrative now is taking robots, which, he has all of two operating at Tesla's California car plant, and sort of, extrapolating that out into, trillions of dollars in earnings sometime out in the future, despite the fact that, this robot, he's saying, is not going to be in limited production until next year. And so, I think there's going to be a lot of, proof in the pudding required to really sort of start to factor that into valuations, at least among some investors.
Yeah, I'm looking at what he said yesterday, Craig. While autonomous vehicle is a $5 to $7 trillion market cap situation, Optimus is a $25 trillion market cap situation, which again is the robots. But isn't this exactly the thing that upset shareholders last time, that it was a Musk who was concentrating on the bots and instead not on cheaper vehicles?
I do think that was one of the interesting things last night was, when he did talk about the car business, which, was only in little spurts, he talked about the notion that, it's tough sledding out there. And so, I do think we're going to find out in the coming weeks that, Tesla has not necessarily, bounced back in a significant way in terms of the number of cars that they're selling. They had a really disastrous first quarter, and we've not gotten indications that things have gotten better, maybe incrementally, and you would expect that just from a sort of seasonal perspective. The first quarter is always, the toughest for the industry. But, this is a company that, is still highly reliant on just a couple of models that are still, fairly costly. And, this plan to bring a $25,000 Tesla to market is very much up in the air and seems to have been, completely set aside in pursuit of this robo-taxi business, which, Musk, again, has been promising for years but not been able to deliver.
Okay, Craig, thank you very much for that. That is Bloomberg's Craig Trudell on the continuing drama of Elon Musk and Tesla. Okay, let's switch gears a little bit here and talk about GameStop. Meme stock cult hero Keith Gill, better known by some as Roaring Kitty, appears to have exited his entire options position in the video game retailer. His $20 calls were traded nearly 142,000 times over the past 2 days. Joining us now for more is Bloomberg's Tom McKenzie. Tom, every time he tweets, Reddits, whatever it's called, posts a screenshot of his position, something happens with GameStop. Everyone gets excited. What's happened this time?
Don't pretend you don't know what happens in the world of social media and meme stocks, Danny. You're all over this. Yeah, Roaring Kitty, deep F -- value, whatever term you want to go with Keith Gill. Look, every time he moves, this stock moves, right? So the details are, again, we haven't confirmed what his exact holdings are, but again, this is on the screen grab that we've seen that he's posted. 120,000 call options that he bought, and they expired January the 21st. It seems like he's sold out of those. He bought them for just over $5, $5.60. He's selling them, it looks like, a range of between 6 to 8, so he's still making money on this. And it looks like he's getting a clearer and a cleaner exposure to this stock because, again, according to this picture and the photo that he posted of his holdings, it seems like he's increased his holdings to about 9 million shares now, which would, in theory, put him at potentially the fourth largest shareholder in this company. But you're absolutely right. Look, there was a lot of volume at play in terms of the options trade and a lot of volatility.
The irony of this is that it was ahead of GameStop shareholders meeting, which apparently they had to postpone because of technical glitches. So you have the situation where the stock is rallying more than 14%. They can't even hold their investor meeting because there are technical glitches. But I guess for the stock itself, Tom, I mean, this thing is continuously volatile. It maybe calmed down before the return of Keith Gill. So what does it mean for the reignition of the meme trade, of the GameStop trade, that we have this out there in the ether yet again?
Yeah. I mean, frankly, we do not know. But what we do know is that the stock was at $45 earlier this month. It's now, as you can see, $28.85. They did take advantage of this, the company, with that share sale of a little over $2 billion US. You're absolutely right. It was like a scene out of the TV series Silicon Valley. They weren't able to hold that shareholder meeting because the tech wasn't working. So we'll wait to see what happens on that front. I'll let you know that the short interest has gone from 20% of the float to 15%. So the short interest, they've pulled their heads in a little bit on this stock.
Another bad day to be a believer in the efficient market hypothesis. Tom, thank you so much. Bloomberg's Tom McKenzie. Okay, coming up, we'll take a look at your headlines around the world here on Bloomberg. Okay, let's get you some of your front page news. First up on the Bloomberg this morning, President Biden has signed a bilateral security agreement to aid Ukraine long term. He's also warning China and their aiding of Russia's war effort. Next up on the FT, France's left-leaning parties have made an alliance for the upcoming elections. However, it shows that the new alliance could be bigger than Macron's in Parliament. And then finally, Donald Trump said that he has told U.S. CEOs he will cut the corporate tax rate to 20% if he wins in November. This from the New York Times. He was in Washington to meet with around 100 CEOs, including Jamie Dimon and Tim Cook. From our global headquarters in New York, I'm Danny Berger. Manish Kabra is on assignment. Let's set your agenda. Kicking the can, the yen slumps as the BOJ makes investors wait another month for details on paring its bond buying. It's a win for Elon Musk. Tesla investors vote for their CEO's $56 billion pay package and the move to Texas. And meme stock investor Keith Gill makes moves on GameStop, appearing to check out all of his options while loading up on shares. 4 consecutive records for this equity market. That's what we've seen this week. A little bit of weakness coming for U.S. equities this morning. So that's what we're seeing. There we go. S&P 500 futures down about 1/3%. The rally yesterday, yes, it had been fueled by a softer PPI, higher jobless claims, yet it was tech that really prevailed. This morning, it is Adobe shares, which are moving higher, some 14% pre-market. U.S. 10-year yields drop another 2.5 basis points this morning. 421 is where you stand on your U.S. 10-year yield. They have fallen 19 basis points so far this week. Meanwhile, the yen continues to weaken, 157, weaker by about 1/3% versus the dollar. We're just speaking with Mark Dowding of RBC BlueBay, who is extremely critical of UATA, saying that he should not have waited to give the details of the bond buying program. And that means that we won't get a hike until September. He is still max short JGBs. Now, even though U.S. futures are down this morning, they are up for the week, and it is a diverging fortune of both U.S. and European stocks. Now, while American equities, as I mentioned, have notched a 4th consecutive all-time high, the Stock 600 has had its worst performance since April. French stocks absolutely pummeled. Look at that, down more than 5%. Their worst since July of last year. All of this has been spurred by political uncertainty after parliamentary defeats that question the fortunes of France's Emmanuel Macron and other left and centrist leaders in Europe. Let's get to Manish Kabra, head of equity strategy at Societe Generale. Manish, thank you so much for joining us this morning. Look, part of the hope for this year was a broadening out of the stock market, was that maybe it wasn't just U.S. tech, that not even just U.S. stocks, but European stocks. Does the volatility in Europe and the volatility of politics in Europe make that trade untenable now?
I would say the European politics, as always, it does flare up time to time. We have seen, even for European equities, predominant of their exposure is outside Europe. Even for CAC 40, 80% exposure is outside France. So I think volatility is definitely the talking point. But usually whenever you have any volatility around the world, most global investors, they switch to the US, and I think S&P keeps benefiting on that.
Yeah, but to be fair, Manish, we do have elections coming up in the US. Is this not just maybe a taste of what's to come in November?
As in, it's a very close poll. As in, you look at the probabilities of different parties. Both the parties, I would say, broadly, they have very different agenda, very different elements, and a lot of different, ways to invest for both Biden versus Trump. But what's not changing under both is literally the fiscal plan. There's no fiscal prudence in the U.S. and hence, I think equities, nominal earnings, they keep getting supported. So I think the overarching theme is literally profits are the glue. Profits are very sticky. Profits are broadening, as in market is not liking that broadening of profits. Market is getting concentrated in certain parts. But, at the same time, I would say one of our biggest call has been, buy NASDAQ equal weighted, even if you don't want to buy S&P equal weighted. There are ways to position on the broadening within certain themes.
Well, to that point, your target is 5,500. Are you preparing to up that target?
Good question. I have already upgraded.
Oh, you have?
I think three. No. I've upgraded 3 times in last 12 months. It's a. We got bullish U.S. stocks. In June last year, we have been upgrading ever since. At this point, it feels like to really upgrade, more from here, we have to expect at least 4 Fed rate cuts. And it's not very clear where those 4 Fed rate cuts are coming. As in we have seen even from the ECB, they waited for 6 months of inflation below 3% before they would go out and cut rates. Same thing happened in Canada, and I think those are the places where I think there has been a lot of to and fro moving parts, a lot of things moving around, but ultimately U.S. bond yields are between 4 and 5. And hence, profits really stays the story, for the equity market. So if I have to sum it down, the 5,500 target to really raise from here, you have to upgrade phenomenally, from already bullish earnings expectations, which can happen, but we need at least 4 Fed rate cuts. We are not expecting any rate cuts this year.
Right. That's the thing, though. Okay, so profits look good, but if you look at what this market is really rewarding, it continues to be those tech stocks, and especially those with an AI bend. Adobe, for example, those shares up 14.5%, I believe, in the pre-market trade, just because they are adapting to the AI environment. Well, Manish, that's not necessarily profit. It's a very specific type of profit in consideration around margins about one specific program and type of offering, that is AI offering. When does it broaden out?
Yeah. So let's think, right, where, we have seen 2 elements, right, as in one, NASDAQ 100, the benchmark index where we have all the tech companies, its profit growth is going to show 35% earnings growth, for the second quarter reporting, which will, happen in the month of July. So as in market is thinking, where is it? I have got the level of earnings growth. And currently, I'm just watching, top 4 tech stock, apart from NVIDIA, but top 4 tech stocks, they're all customers of NVIDIA, and, watching the revenue trends of those companies, they have mid-teen revenue growth. And I think that's what fueling the earnings excitement. And that has been the story, that has been the key call, which is if you're going for level of growth, it's in NASDAQ 100. If you're watching direction of growth, then it's outside NASDAQ 100.
Okay. So if it is the direction of growth, I mean, small caps have not done well. It's a lot of head fakes, a lot of optimism for them. They still haven't. I mean, these are companies that have a lot of floating rate debt that don't do well in a high rate environment. Manish, my question to you is, even if we get 1, 2, 3 rate cuts, is that really enough to solve the issue that small caps are facing, that they do have to face this refinancing wall, maturity wall that's going to be coming in 2025 and 26?
Yeah. So profits for small caps, it's flat, flat for 2 years, despite very strong nominal growth backdrop. And you're absolutely spot on. There's, phenomenal pressure, for small companies on refinancing on the level of rates. What really solves here, as in typically, when does it small cap earnings outperform large caps? When does it, small caps outperform large cap? Usually for those things, we need yield curve of at least 100 basis points. And we are far away from that. And hence for, almost 3 years, the trade we have pushed, long S&P, short Russell, there's no rush to change that. But, at the same time, I think it's so much still hinges on to what degree, Fed will cut rates. If I look at mid-90s backdrop, non-recessionary rate cuts, Fed had maximum 3 to 4 rate cuts, and they stopped it. But at the same time, we had 6 years of outperformance of S&P versus Russell. As in currently, I would say we are only 2/3 of the way into that outperformance trade. So I think small caps are stuck, but ultimately, when do you buy it? Whenever you get conviction, yield curve is at least 100 basis points.
All right, Manish, we're going to have to leave it there. Thank you so much for joining this morning. Manish Kabra of Societe Generale. Okay, coming up, I mentioned it, Adobe shares set for their biggest gain in about 4 years. We'll break down the earnings for you next. It's your Bloomberg Brief on this Friday morning. I'm Danny Berger in New York. President Biden has hailed a 10-year security agreement he signed with Ukraine. It's a sign that Washington and his allies are not backing down from their support.
Another reminder that to Putin, we're not backing down. In fact, we're standing together against this illegal aggression. The agreement that President Zelensky and I just signed also lays out our shared vision for a just peace, a peace rooted in the UN Charter and the principles of sovereignty and territorial integrity, a peace with a broad base of support around the world that holds Russia accountable for the damage it has done in this war. Taking 3 major steps at the G7 that collectively show Putin we cannot wait us out.
The G7 yesterday had agreed to use profits from frozen Russian assets to provide $50 billion in aid to Ukraine. For more, let's go live to Puglia, Italy, where Bloomberg's Oliver Crook is there for the summit. Oliver, we had this agreement. I mean, I guess it was this elegant way of not actually using the funds themselves, but instead using the interest earned on the fund. So this agreement, how straightforward is it? How easily will it be implemented?
Right, so the idea, Danny, is to cut a check basically today for the future profits, right? And that's about a $50 billion check. And that is what the political leaders here in Puglia have agreed to of the G7. And that'll really take the form of a loan to Ukraine that will then eventually be repaid by the future profits on these Russian assets. Now, that sounds maybe simple. That doesn't even sound that simple, but it's even more complicated than that, because you have to sort of make sure that, for example, if these Russian assets were to thaw, let's say that there's a peace agreement at some point in the future, who is going to make that whole, right? This cannot touch the taxpayers of the G7, because this will only fuel a lot of the pressure that some of these G7 leaders are feeling at home. Let's add another complication here, Danny. These EU sanctions that actually freeze the assets need to be renewed every 6 months by the EU unanimously by every country in the EU. Hungary, for example, doesn't often like to play ball with these sorts of things. Could that block? So these are the sort of technical aspects that really need to be worked out, Danny, if they want to move forward with this. And they really want to move forward with this and get the disbursement by the end of this year, Danny, because the other thing is many of these leaders, though they say they'll be there till the bitter end, they may not, because they may just simply not be reelected. So really they need to future-proof this sort of effort on their part, and that is what the G7 wanted to sort of unify and do here.
To that point, Oliver, I mean, it is basically Maloney's show. The rest of them, France, Germany, even in the U.S., there is, as you say, a question as to whether they'll be there next year, especially after the European parliamentary election. So in this idea, as you say, to future-proof some of the aid they've given, how successful have they been that, not just in Ukraine, but really their presence in the G7 and the impact that they can have today?
Yeah, so listen, Danny, I mean, the Ukraine has sort of been the big topic, and the sort of $50 billion, that was sort of the big deliverable here. But this wouldn't really be a G7 meeting, Danny, if the topic of China didn't come up. So obviously this question of overcapacity has come as a sort of center stage. But there's another one, Danny. There's also the sort of influence that China has over the world in a time when there's sort of a more fragmented bipolar world, right? That is part of the reason why they've invited leaders from other countries outside of the G7. I mean, by my calculation, latest, it's closer to a sort of G14. You have Turkey, you have Brazil, Argentina, you have Kenya. And I think for many of the leaders here, they're aware not just of the trade distortions, but the influence that China has in these countries. I spoke to the European Council President, Charles Michel, about this, and basically asking, has the G7 failed to sort of exert its influence in the global south to the benefit of China? Have a listen.
We have to engage with the so-called global south. We have to listen to their concerns. We have to explain what are our priorities, and we have to build strong partnerships with them in a spirit of mutual respect, in a spirit of mutual confidence.
So U.S. officials and Western officials are very cognizant of the fact that they often show up in some of these global South countries and talk a lot. When China shows up, they build things. So one of the measures that they've taken here is a sort of investment fund on sort of energy and infrastructure that's been backed by Brookfield and BlackRock. And this is a $4 billion fund that's supposed to sort of touch these things. But we need to place it always, Danny, in that geopolitical context about global influence.
Okay, Oliver, thank you very much. Enjoy the rest of your time there in Puglia. Hopefully you get some time off now to enjoy the sun. Oliver Crook reporting live from the G7 summit in Italy. Okay, let's get you a check on Adobe shares this morning because they are set for their biggest gain in about 4 years after catching the AI wave. A nice even 15% is what they're up this morning. Let's get over to Matt Bloxham from our Bloomberg Intelligence team. Matt, I thought Adobe was supposed to be one of these companies that was threatened by AI, that AI could replace. Instead, they're using it. What exactly went on?
Yeah, it's interesting, isn't it? I mean, it's a company that investors are really struggling to kind of put in the right bucket. You know, I think going into the results, as you say, people were very worried that we were going to hear them talk about a commentary that was showing that pressure we were talking about from generative AI tools that lots of other companies who hadn't heard of a year ago are now developing. But I think they've done a very good job. Firefly is their kind of generative AI engine, if you like, integrating that into their suite of creative products, things like Photoshop, and that's landing really well with, I'd say, professional users of these products. So I think obviously a lot of consumers are taking advantage of things like Midjourney, which are free to kind of get more creative, but professionals are still trusting people like Adobe to deliver what they need. And that's to some degree because of these issues around copyright. And the Adobe systems, certainly for the image generation, are trained on a kind of copyright safe, if you like, environment, and that's giving confidence to business users that they're not going to suddenly land in some kind of legal issues further down the line. So, the products are developing, are landing well. They're really taking advantage of their own investments in generative AI. But even, I think, in the consumer space, they showed signs overnight that actually they're getting some traction against some of those newer competitors. So, I think this was definitely a surprise to the market in terms of the positive and upbeat commentary that the company provided.
Matt, if we just take a step back, because you could look at this week's earnings of Adobe talking about AI, Broadcom talking about AI, and say, okay, we're back to the era where all you need to do is mention AI in your earnings call and in your earnings report, and you rally. But let us not forget that we also had Meta this earnings season. We also had Salesforce this earnings season, who tried to do the same unsuccessfully. So what has differentiated the haves and the have-nots between the tech companies who are trying to tout their AI offering in their earnings?
Yeah, it's a good question. I think some of these companies like Salesforce, because they're perhaps kind of their kind of AI journeys perhaps a little kind of later in the cycle, and their revenues much more heavily reliant on, I guess, kind of more regular mainstream IT service spend. And what we have seen is the economic environment isn't supporting huge budgets for IT spending, so they're feeling that pressure too. And what budgets there are shifting to very much the kind of first wave of AI investment, which is kind of playing into kind of a very small group of companies like Nvidia, for example, and some of these companies like Meta are having to increase their investments in the infrastructure that they need to actually deliver these AI services that sit on top of them. So there's a kind of mixed kind of set of messages going on there, kind of dynamics. The companies that have really benefited so far, this very small group like Nvidia, that are very much at the first wave driving this generative AI revolution. But even though things feel like they've changed a huge amount in the last 12 months, we're still very much at the early stage of this journey. I think there's still a huge amount of change to come this year, next, and the year after in terms of how this market evolves. More products coming to market. Some of the companies that we're talking about today will probably fade. There's a bunch of companies that we don't even know about yet that are going to come into the prominence over the next year or two. So I think there's going to be a space that keeps us talking and scratching our heads for quite a while.
Yeah, Matt, I think the point that there are going to be some things that fade, some things that AI replace. We're all excited about the winners now. I don't know if we've really contemplated the other side of that. Matt, Thank you so much for joining us all this week. Matt Blocksham of Bloomberg Intelligence. Okay, you might have noticed my lovely co-anchor Manish Kabra has not been here because he's been in Rio. So let's head over to there where Manish sat down with the CEO of Vale to discuss his outlook for minerals and deals in the space. He was speaking on a panel at the FII Institute conference. Take a listen.
In 2000, they were producing 100 million tons of crude steel. In 2010, they were producing 600 million tons. In 2020, they're producing 1 billion tons. This is a super cycle. Where can you see that again? You can see that in nickel, you can see that in lithium, you can see that in copper, but the only commodity today that is being perceived as a no-brainer is copper. So I don't see super cycle. By the way, I see a super cycle smallish on high-quality iron ore. Canada, I think Monday just put iron ore, high-quality iron ore, as a critical mineral that we was always fight over, because it's a matter of how can you triple or double, triple demand. So that's where the super cycle comes.
But do you think that the regulation that they've introduced on the housing, sorry, I'll let you finish in a second, do you think what they've done on housing, you've got to talk about EVs, he's got to talk about housing, do you think the policies enacted in China will clear the surface?
China has definitely plateaued. I didn't listen to my CFO yesterday, but I'm sure we talk the same. We plateaued, but at a decent level. It's going to plateau for a while because China has all their means, although they really rely on real estate. They have to tame the downside of the real estate, but they're shifting their industry like every other economy did. So China is in a plateau for that, and it's going to consume the rest. So that's, I think, where it will go.
We saw a massive mining deal fall apart. BHP, Billiton, and Anglo-American. In many ways, what this says to me, there will be a race for M&A, especially in sustainable critical minerals, on a fast response. Don't you say to me 80% of my world is iron ore. I want to know whether you've got FOMO on not doing a deal in critical minerals that we talk so much about.
Very, very, very fast. We are very unique because we have a growth platform in iron ore that is 80% of our business. We can grow from 320 to 350, 360, so that's it on high quality. And we had a deal with Manara, by the way. We already did our deal. We had a partnership with Manara, that is PIF and Ma'aden, for 10% of our base metals business that we want to grow. We want to double our production of nickel and triple our copper production. So we have enough in our plates to do it. We don't need to merge with anybody. We don't need to do like the other ones that have to merge. But if anybody wants to talk to us, we are open.
It's your Bloomberg Brief. I'm Danny Berger in New York. Let's get you set up for your trading day on this Friday. We're going to get UMich Sentiment Survey. That comes out at 10 a.m. Eastern. And then don't miss this one. Bloomberg's Mike McKee will be sitting down with the Cleveland Fed President Loretta Mester. That's at 1 p.m. Plus, we're going to hear from ECB President Christine Lagarde. She will be speaking at 1:30. Okay, some individual movers for you. Tesla, investors backing Elon Musk's pay package, $56 billion. It moved higher yesterday, up another 1% this morning. Pinterest, that is extending declines. Piper Sandler noted weaker growth in Amazon traffic, down more than 4.5%. I want to leave you with this, though. The Kakaron down very much so this morning. It's down 5% for the entirety of the week. It has now erased its entire gains for the year. That is political volatility, plain and simple. It's not American exceptionalism. It's European exasperation. That's it for Brief. Surveillance up ahead.